What's up, everyone? Before we start, I want to remind you all to subscribe. It's free to do. It helps this channel and helps you stay alerted when a new video comes out. Now that we got that out of the way, let's begin. Today we are focusing on everything Tesla. Company overview. Tesla is the world's largest producer of electric vehicles. In less than a decade, Tesla has grown from a small company to a global luxury car manufacturer. Tesla manufactures luxury sedans, compact vehicles, and SUVs. Tesla also intends to release new models in the coming years. Electric vehicles will become more commonplace in the near future, and Tesla wants to maintain its market leadership. As a result, to meet demand, the company is increasing production capacity. Tesla, for example, invests approximately 5% of sales in R&D to improve its market-leading technology and lower production costs. Electric vehicles must be affordable and dependable in order to be widely adopted. The automated and efficient manufacturing process used by Tesla reduces the number of parts required to assemble a Tesla vehicle. In addition, producing batteries cuts costs in half. However, in order for electric vehicles to be functionally equal, the number of charging stations must be increased. With increased battery density, Tesla's electric long-range vehicles will match the range of ICE vehicles. Tesla is steadily expanding its supercharging infrastructure, which now includes highway and city fast chargers. As a result, insurance and other fees, such as self-driving cars, have increased. Tesla also sells solar panels and batteries for residential and commercial use. As a result, Tesla is well positioned to expand in the solar and battery storage markets. Fair value. By 2031, Tesla is expected to produce 5.25 million vehicles. This includes Tesla's expanding fleet sales division. Tesla's target of 20 million vehicles far exceeds our expectations. Despite the fact that this is 5.5 times the 936,172 cars expected in 2021. The Model Y should sell well before Tesla's light truck, sports car, semi-truck, affordable sedan, and SUV platforms are introduced. We anticipate that Tesla will reduce vehicle production costs even further based on these findings. As more expensive Model Y cars are purchased, automobile profit margins will grow faster than revenue. Profits will thus exceed revenue. In addition, revenue is expected to increase as a result of subscriptions for self-driving cars. We are also optimistic about the future of the insurance industry. We expect the energy storage industry to grow at an annual rate of 8% due to the high demand for solar panels and energy storage systems. Battery cost cuts should aid ESS price cuts, but not profitability. Production expansion should result in lower production costs. Profits from the trading of AI software and long-term power purchase agreements are expected. Enphase and SolarEdge efforts will be beneficial. However, Tesla will need to spend approximately $125 billion over the next 10 years to fund this expansion. In addition, Tesla's self-driving vehicle ride-hailing business accounts for roughly 7% of our total value. Tesla drivers will be charged 75 cents per mile if the company has a market share of 2.5% in the United States, Europe, and China. Dojo's AI training services and the sale of humanoid robots are also included. Economic moat. Tesla receives a narrow moat rating from us. Tesla's moat is comprised of intangible assets and cost-cutting measures. The company has a strong reputation as a luxury automaker, which allows it to charge higher prices for its vehicles. However, because of its expertise in producing electric cars, it is able to sell its vehicles at a lower price than its competitors. We do not believe that other automakers producing battery electric vehicles will harm Tesla's brand. Instead, we believe the company will continue innovating to stay ahead of startup and established competitors. Tesla was able to garner a lot of media attention by focusing first on the luxury car market. As a result, many people expressed an interest in purchasing Tesla vehicles. Furthermore, we believe that the company's strong brand will keep people interested in new cars, such as the Cybertruck or the platform that will enable the production of affordable sedans and SUVs. Many service needs do not necessitate a visit to a store. Instead, Tesla will pick up the customer's vehicle at their residence and return it the same day with a fully loaded loaner vehicle at no cost. They will also come to the customer's home or workplace to service their vehicle. This experience is far more user-friendly than many other car companies, which benefits Tesla's brand reputation. Tesla has proprietary technology that contributes to its success. However, because electric vehicles are new and highly engineered, this intangible asset only applies to them. To maintain its best-in-class range, the company invests nearly 6% of its sales in research and development. Tesla is also heavily investing in its own self-driving technology, having constructed one of the world's largest supercomputers to train self-driving AI. As a result, there is a good chance that Tesla will be able to maintain its unique technological advantage even if it spends the same amount of money on R&D as its competitors. Tesla will face increased competition in the coming years. This is due to car manufacturers' desire to make their vehicles more electric. As a result, electric cars will account for 30% of all car sales by 2030, up from 3% in 2020. This will aid market growth as electric vehicles gradually replace internal combustion engines. Tesla's technological advantage and brand strength will remain constant as new models are released, allowing the company to continue charging higher prices for its electric vehicles. We believe Tesla has a significant advantage because it quickly produces a large number of electric vehicles. Tesla's total vehicle production has increased from around 100,000 in 2017 to nearly 600,000 in 2018. The cost of goods sold per vehicle has dropped by 55%, from $84,000 to less than $38,000, while gross profit margins have increased from 23% to just under 27%. This is partly due to the company's preference for midsize and SUV vehicles over luxury vehicles. The majority of this is due to the company's ability to reduce manufacturing costs. Legacy automakers are gradually shifting away from producing cars powered by internal combustion engines and toward creating electric vehicles. However, even as other automakers begin to produce electric cars, we believe Tesla will maintain its low prices because it plans to cut battery cell costs by 56% over the next few years. We believe Tesla's combination of intangible assets and cost advantages will continue to propel it forward. As a result, the company will be able to generate above-average returns. As a result, for at least the next 20 years, Tesla will be able to outperform its cost of capital. However, the next 10 years will be fraught with uncertainty for Tesla and the rest of the automotive industry, due to the rapid development of autonomous vehicle technologies that may change how people use cars. As a result, we believe the narrow moat rating is superior based on the 10-year extra return duration. What is the risk? There are a lot of unanswered questions about Tesla. Electric vehicles may remain a niche market if mass-market consumers do not adopt new powertrain technology. In addition, EVs may be affected by other powertrain technologies as well. When the economy turns down, demand for automobiles plummets dramatically. As a result, traditional and new automakers are increasing their pressure on Tesla. In addition, because there are now more electric vehicles on the market, Tesla's reputation may suffer. Because of this, delays and cost overruns are very likely as the company makes significant investments in expanding its capacity. To keep its technological edge, the company is also putting money into research and development, R&D. Unfortunately, there is no way to know whether or not these investments will pay off. As a result of his stock holdings, Tesla CEO Elon Musk is putting the company at risk of a large debt repayment sale. Additional risks include environmental, social, and governance issues that Tesla must address. As a manufacturer of automobiles, Tesla is at risk of recalls due to product defects. Their self-driving software is also included in this. Other risks concern employee retention. If Tesla cannot keep key employees, such as CEO Elon Musk, its positive brand image may suffer. In addition, delays may occur if the company cannot retain production line employees. Another risk is the possibility of patent litigation. To improve its electric vehicles and energy storage systems, the company relies heavily on cutting-edge technology. Tesla may also face regulatory challenges in some U.S. states due to laws requiring automakers and dealers to be separate entities. What does the future hold? We give Tesla an exemplary capital allocation rating based on their balance sheet and investment decisions. Their balance sheet is sound, in our opinion. However, Tesla's revenue is highly cyclical, and most of their debt and finance lease obligations are due within the next 3 years. But, with a healthy balance sheet and more cash than debt, Tesla is expected to meet their financial obligations and either repay or refinance their upcoming debt. Tesla's investments are exceptional, in our opinion. Tesla's goal is to increase its EV production from 500,000 units in 2020 to 20 million by 2030. With that in mind, Tesla is investing in new factories worldwide, particularly in the United States and Europe. Given the high level of consumer demand, we believe the capacity expansion plans make sense. We also support Tesla focusing on lowering manufacturing costs while maintaining its technological advantage. This will allow Tesla to increase profit margins on existing vehicles and produce a profitable, affordable sedan and SUV in the future. We also believe Tesla is wise to consider adding secondary revenue streams, such as selling insurance and autonomous driving software, which can both increase total customer spending. Thanks for listening, everybody. Please subscribe if this kind of content interests you. We post content like this every week. Also, remember to smash that like button.